Today I answer the question, what is dedicated Side A coverage in a D&O policy? A D&O policy commonly has three sides or parts which are simply identified as Side A, Side B, and Side C. This is true in both private company D&O and public company D&O. As a refresher, Side A protects the organization's directors and officers from unindemnifiable claims, and we're going to dig into that in just a second. Side B reimburses an organization for the costs they incur in indemnifying their directors and officers, and Side C is entity coverage. In public companies, Side C provides protection only for securities litigation, and in private firms, Side C is broader protection to respond to any claim where the corporation is sued along with the D's and O's. For directors, Side A is the most important part or side of a company's D&O policy because it applies solely to cover the directors and officers of the firm. It is triggered when or if the entity is unable to indemnify the directors and officers or refuses to indemnify the directors and officers in a claim. I've often said that D&O insurance, and most specifically Side A, is personal net worth insurance. This is because lawsuits which allege management or leadership wrongdoing or malfeasance will name leaders individually, putting those leaders' personal assets at risk. Now, why would a company be unable to or refuse to indemnify its board when a D&O action arises? Commonly, these defense refusals occur when the company or organization files for bankruptcy or insolvency, or there's a legal prohibition against indemnification. In the case of insolvency or bankruptcy, the company's D&O policy often becomes an asset of the bankruptcy estate, and the courts will bar indemnification. Also, in a fundamental sense, if the firm is insolvent, there's no funds left to provide indemnification. So the company leaders are bare for protection from lawsuits which often arise in bankruptcy and insolvency situations. Legal prohibitions often include derivative actions. In fact, the state of Delaware does not permit indemnification of settlements in derivative lawsuits. And then there are regulatory, criminal, or bad faith acts of directors and officers which can bar indemnification by law. Finally, there are situations in takeovers or reconstitutions of a board that can trigger the board to refuse indemnification of a prior board, and those directors and officers will find themselves out in the cold without protection. So, whether the directors and officers are not able to be indemnified for their potential liability by law, or they are refused indemnification, there's a tremendous gap which puts the personal assets of those company leaders at risk. This is where a dedicated Side A policy steps in to protect the directors and officers. Dedicated Side A essentially sits on top of a traditional D&O policy or on top of a tower of D&O coverages which are arranged to provide high limits of protection from D&O lawsuits. It is a policy or layer of protection solely for the directors and officers in the event that all other coverage parts, layers, or policies are exhausted or become unavailable, as we previously discussed. Essentially, it becomes the last line of defense for directors and officers. Now, there are actually two different forms of Side A protection. The first is standard excess Side A coverage. The second is broader DIC, or difference in conditions Side A coverage. Side-A DIC is the preferred coverage form over excess Side A for a few reasons. The first is that Side-A DIC will provide what is known as drop-down coverage to provide protection where a straight excess Side A policy will not. This occurs when an underlying policy is not exhausted. When an underlying insurer may refuse to pay a claim and it doesn't exhaust its limit, a straight excess policy is not triggered, and no coverage is provided to the directors and officers. Side-A DIC does drop down in this situation and protects the company's leaders. Second, Side-A DIC coverage is broader than straight excess Side-A. It has fewer, if any, nasty exclusions, and it is non-rescindable and non-cancelable. Side-A coverage, whether excess or in a DIC policy, provides exclusive limits just for the directors and officers. They are not shared with the entity as in a traditional ABC policy, and in both the DIC and straight excess Side-A cover provides first dollar protection, as there is no retention in this policy layer. Here's the bottom line. If you're an owner, executive director, or other officer within a private or public company, D&O insurance is critical to protecting you and your personal net worth. Crafting a D&O protection program properly to give you the most protection possible takes an expert. It's not something that should be left to a broker who only dabbles in management liability insurance. I've been involved in D&O and other management and professional lines of insurance since their inception in the early 1980s, and I work with a variety of large private and small public companies in this area. If you need a second opinion on your management liability insurance program or are looking to purchase D&O insurance for the first time, give me a call. My contact info is coming up in a second, and I'd love to chat with you and see if we'd be a good fit for you and your firm. Thanks.